Let's do questions on cost method, on the fair value method, right? And I would expect you to answer. These are the MCQs we have for fair value method. In its financial statements, Pair Inc. uses the cost method of accounting. Now, when I say cost method, it means the fair value method of accounting for its 15% ownership of same company. At December 31, Pair has a receivable from same. How should this receivable be reported in Pair's December 31 balance sheet? The total receivable should be reported separately. The total receivable should be included as a part of investment in SAVE without separate disclosure. 85% should be reported separately with the balance offset against SAVE's payable. The total receivables should offset SAVE's payable to Pair without separate disclosure. So a parent owns 15% of a subsidiary. Now, if the parent has a receivable, how should that be reported? That's the question. Parent company owns 15% of subsidiary. Now, subsidiary has a payable due to parent and parent has a receivable from subsidiary. Now, in the parent's balance sheet, there is an accounts receivable from subsidiary. Right? That's there. Now, because the ownership is less than 50%, will not consolidate. So the assets will not be touched. They should be reported separately. No issues there. It should not be merged with the investment at all. It should be reported separately that, okay, hey, we have an investment in same company, not a problem, but we also have a separate receivable due from them because they are separate entities. Will not eliminate anything at all. We will not eliminate anything. So 85% should be reported separately with the balance offset. No. The total should be offset. No, will not eliminate anything and it will not be merged with investment. It will be reported separately. The next one, Wood Company owns 2,000 shares of Arlo Inc.'s 20,000 shares of $100 par 6% cumulative non-participating preferred stock and 1,000 shares of Arlo's common stock. So Wood Company, we own 2,000 of the 20,000 shares, 2,000 preference stock and we also have 1,000 common stock, 1,000 common stock, 1,000 shares. This represents, this is 2,000 out of 20,000, 2,000 out of 20,000. This represents a 10% holding, right? Whereas common stock represents a 2% holding. Now, common stock is less than 20%, so it's fair value method, and preference stock, the way we discussed, it will never give you significant influence because they don't have voting rights. Now, this is the ownership you have, right? Now, the value of each share, the value of each preference share is $100. $100 is the value of each preference share. This is their holding. Value is $100. That means the total value of preference stock you own is $200,000. That's the total value of preference stock. And they're cumulative in nature. So cumulative preference stock means if you don't pay them the dividend in a particular year, their right to receive the dividend doesn't lapse. They will still receive it when you pay the future dividends, right? Now, no dividends had been declared or paid the previous year also. During the current year, Arlo declared and paid $240,000 dividends on preferred stock. Now, $240,000 dividend has been paid on preferred stock, right? Now, you own 10%. So how much is the dividend you will receive? The dividend we will receive is 10% of that, which is $24,000. That's the dividend we have received this year, right? No dividends had been paid in the previous year. Wood received a 5% common stock dividend from Arlo and the quoted market price was 10 per share. Stock dividend is not recorded like we discussed. We only increase the value of the shares. So what is the dividend income we'll report? We'll report $24,000 as dividend income. Stock dividend is not reported. It will only increase the number of shares and the value will be allocated to a greater number of shares owned. And if you think about it, right, these were 6% shares, 6% cumulative shares. So your dividend on them for 1 year would be 12, and dividend was not paid last year as well. So that becomes again another 12,000. 24,000 is the total dividend paid. 12 for this year, 12 for last year. Are we clear with this MCQ, everyone? Okay. The next one, you guys got to answer it. Sort Inc. has a portfolio of equity securities, which it does not intend to sell in the near future. At the end of the year, the fair values of the securities exceeded their cost. So at the end of the year, the fair value is more than cost. No problem. How should SOR classify these securities, and where should the unrealized gain should be again? So first of all, you have equity securities, right? And the fair value exceeded their cost. How do you classify equity securities? That's the first thing. How do you classify it? I'll talk about the recognition of gain later. How do you classify it? Trading, available for sale, held to maturity, or fair value through net income. What method do you use to classify equity securities? Dehot says, okay, Daisy available for sale, no. Diana available for sale, no. How? QD. Okay, guys, we gotta fix this. Only debt securities are classified as trading, available for sale, and held to maturity. Only debt. There has been an update. This update was done 3 years back, so it's been there for quite some time. Debt securities are classified for trading, available for sale, held to maturity. This classification is no longer for equity. This is only for debt. If you're going to sell it in the near future for debt, it's trading. That's not the correct answer. I just clicked it to explain it. So ignore that click. Trading is for debt if you're going to sell it in the near future. Available for sale if you don't know when you're going to sell it. And held to maturity if you're going to hold it till maturity. But this is only for debt securities. Only if you invest in debt instruments of another company. For equity securities, again, the way we account for it, if you have no significant influence fair value method, if you have significant equity method, and if you consolidate, if you have control cost, then you consolidate. So you account for them using fair value through net income. And the unrealized gains and losses, like we discussed, goes through income statement. Are we clear with this, everyone? Great, awesome. I hope you're all clear. Debt is trading, available for sale, held to maturity. You never associate all these three classifications with equity anymore, ever. At the beginning of the year two, a company invested 40,000 in marketable equity security. So if you invest 40,000, right, in a marketable equity security, the journal entry would be investment in equity security to cash $40,000. At the time, the security had readily determinable market value. The security had known market value, and the security had a fair value of 28,500. The change is temporary. How should this change be reported? So the fair value has gone down. You will report an unrealized loss on investment, and it will reduce the investment in equity security. By how much has the investment gone down? It was 40,000 earlier, and now it's 28,500. So the value has declined by 11,500, and that is the loss that goes on to income statement. It's reported as a part of net income. Again, there is no longer classification of equity securities as trading or available for sale. No longer need to do that. Now, during year three, Gilman Company purchased 500 shares of the 500,000 outstanding stock for $35,000. Okay. So we purchased 500 out of 500,000. We purchased 500 shares or 5,000 shares. We purchased 5,000 shares of 500,000 shares. So what is our percentage holding? We hold 1%. We hold 1%. So we have no significant influence. Always establish that first. And therefore, we must use fair value method. Now, when we purchased it for $35,000, the journal entry will be $35,000 cash. That's the journal entry will pass when we purchased it. Now the unrealized loss. Okay, Gilman received 1,800 of dividends from investment in Meteor stock. That will be cash to dividend income. You have received 1,800 dividend from this stock. That will come in here. The fair value at the end was 32,000. So there's a loss from 35, it's 32. So how much is the loss? The loss in this case is from 35, it's 32,000. The loss is $3,000. Now this loss goes on to income statement. And this income goes on to income statement, the dividend income. These are the two items that goes on to income statement. What amount should be reflected in Gilman's earning for year 3? Income of 4,800. What will be the total amount reflected in the earnings? You have an income of 1,800. You have an income of 1,800, and you have a loss of 3,000. So the net amount going is a loss. Profit of 1,800, loss of 3,000. It's a loss of $1,200. That's what goes in there. Are we clear with this? That's all about the fair value method. That's everything we need to know about the fair value method. Now, I think we wrapped it up quite early. Actually, I think I miscalculated it. My idea was to have the session go for 1.5 hours, but I also wanted to restrict it to topic by topic. So let's say today is fair value method and next is equity method. Now, I think probably we could have done both together, but I decided we'll break it down so that we can practice more questions. But yeah, I think that makes sense because equity method will have around 20-25 questions. So I'll need more time for equity method. So that's all we had for today, right? Now, next week we'll do equity method. And post that, so I've shown them as a separate topic, but I want you to believe and imagine that, okay, combination is a continuation of equity method, right? Versus combination is a continuation of equity method. So we'll continue from that. But I hope you're clear with fair value method completely. I hope this is very clear for you. There is no session next week. We'll have the session week after. There's no session next week. We'll have a session week after, but that's the equity method. Now, in case you have any questions, you can ask them. I hope if you go to the new page as well, you'll get an idea there. So this is where we've explained it, right? We'll have these sessions every week, right? These are the links to launch the session. In case you have a question, where you have, let's say, you can't join in for the session, you can send them over here and we'll be releasing the replay, and all the replays are already right here. And once a week on Saturday, we'll do an open sparring. So in case you have any questions, you can ask them now and I'll try to answer them. I'm going to watch the reruns. Yes. My exam is 9th November. Anybody else testing that soon? I'm sure there must be somebody here itself. But guys, in case you have any questions, you can ask them now. Normally the sessions would go on for 1.5 hours. I think I, miscalculated it since we are doing it after such a long time. So, but yeah, normally the sessions will be a lot more, but I think the topic was simpler today and that's why we finished it earlier. I was wondering what happened to the CRAM, MCQ and SIMS. We are going to do that at certain point in time. We are going to do that, right? So it's still in works. Exactly when we don't know, but it will happen. It will happen. So because we did the regular sessions, we'll do the CRAM, MCQs and SIMS as well. So